Welcome to the True Commercial Real Estate Podcast, your ultimate investor resource for all things truly commercial. Whether you're interested in industrial, retail, medical office, storage, single tenant, or any other type of non-residential real estate investment, this is your podcast. Hey everybody, Logan Hartle here in Aurelian. We're here for another podcast. Today we have Neil Wahlgren. He's the Chief Operating Officer of MAG Capital Partners. So Mr. Wahlgren brings nearly 2 decades of leadership and operations in capital markets to MAG Capital Partners. He's raised equity for over $450 million in real estate and operating companies. Prior to joining MAG Capital Partners in 2019, Mr. Wahlgren led a Bay Area real estate investment firm for 3 years, growing all aspects of the business to assets under management exceeding $500 million. As an American serviceman, Mr. Wahlgren logged over 2,500 flight hours piloting a C-130 in the Air Force and Navy. Following combat tours in Iraq and Afghanistan, he concluded his military career as a lieutenant commander. Mr. Wahlgren now resides with his wife and son in San Francisco, where they enjoy flying, sailing, and tennis. He holds a BS from the Air Force Academy, earned his MBA from Texas A&M University, and an MS from Troy University. That's one heck of a resume there, my man.
I like when you read it.
Yeah.
It's got a nice ring to it.
Phenomenal, man. Phenomenal. Well, thank you for joining us. I really appreciate it.
Yeah. Thanks for having me, Logan.
Yeah. So just to get started, can you tell us a little bit about your background and how it's led you to where you are today?
Yeah, I mean, it's hard to top the intro you just gave me. No, in general, had an early chapter as a military officer and pilot, and it's kind of interesting. At the time, I was kind of my late teens, going into the university there, the military school, and then my early 20s. Really, it was exactly what I needed to be doing then. I needed some structure, some excitement, and really it taught me some great skills. And parallels there are, and how many just consistencies between how you kind of prep for a flight and how you prep for a deal, and checklist discipline and consistency. And I think a lot of those kind of early experiences really helped both on the capital market side and really seeing commercial real estate investments start to finish pretty directly.
No, that's awesome. That's awesome. Thank you for your service. I've not served myself, so I very much appreciative of that. And I can imagine that there is a lot that you can learn that you could bring over to this world. There's a lot of due diligence to be done, as you mentioned, checklists and keeping track of things as they're going through. So now I really appreciate that. So can you tell us a little bit about MAG? Is it MAG? Do you short it to MAG? Is that what it is?
Yeah. MAG,
Okay.
MAG Capital Partners.
Cool. Yeah. So yeah. So tell us a little bit about MAG Capital and what you guys have going on there.
Sure, absolutely. So founded by 2 guys, Dax Mitchell and Andrew G. I've known them for about 5 years. But really, these guys are real estate veterans. Dax has been a commercial real estate broker for about 20 years. Buying, selling commercial single tenant real estate, and eventually kind of evolved that skill set into investing on his own, and then with friends, then eventually to MAG Capital. Andrew's our valuations expert. So he's a full commercial real estate appraiser by trade. So he really comes from that valuations background, CCIM kind of master modeler. He's really the numbers guy, making sure you're buying good basis real estate is the core to anything in the commercial real estate world. And then my skill set, I bring capital markets. So really have a team, and we work, once we've kind of wrestled down a deal for the most part, that whole, how do you package this? How do you communicate this in an effective way to your investors to, really have them see the same opportunity in the project that we do. And so, we invest alongside them. We raise capital from a group of, really loyal kind of repeat investment partners. And then we also work on the debt side to bring in, usually regional or local banks that we work with, kind of on a multiple basis to provide lending on the projects to purchase them as well.
Awesome. That's phenomenal. That's awesome. Raylan's going to dive into a little bit more about that. He's got a few questions about MAG.
Yeah, thank you so much, Neil, for your service first, and thank you for being with us tonight. So, what size transactions do you guys typically handle or tackle?
Yeah, I wish I could give you, just a go-to answer, but really we're kind of opportunity first. So we'll look at, the deal if it comes to us in the right channels, that to us as an investment group, finding creativity and value add is more important than the core deal size. But that's that, we do have, kind of to be and general parameters. So, from when we're buying commercial industrial real estate, most of our projects over the last, 12 months or so have been, roughly about 12 to 22 million or so, somewhere in that range. Although we do, like I said, if the opportunity is right, sometimes go a little higher or a little lower.
Fantastic. And do you have a specific geographic location you specialize in?
Yeah, we found most of what we buy is in the Midwest, kind of from Michigan all the way down to South Texas. And, for a long time, I thought it was really specifically cap rate driven, but really a lot of it comes as well to the type of industries that we are, effectively partnering with when we buy real estate around them. They're national manufacturing firms that ship coast to coast. So really being in that kind of central corridor makes sense from a geographic standpoint as well.
Okay, yeah, that makes sense. And how does a company like yours, Mag, source deals?
Yeah. So largely we are buying, it's always good to have a niche, right? And, there's a 1,000 different niches out there for what specialty you want to create in commercial real estate. But really what we've found as a team and brought to the table is we buy almost exclusively through a mechanism called sale leaseback. So we are buying real estate from owner occupants. So imagine a manufacturing firm that owns the real estate that they manufacture out of, and they sell us the real estate, and simultaneously they'll sign a brand new, typically long-term triple net lease. So that is the dynamic. And in the sale leaseback world, there's really it's a very specialty minded subset of commercial real estate brokers that have the really the know-how and experience to execute a sale leaseback, just because it is a more nuanced transaction. So of those, it's probably just a couple dozen nationwide of sale leaseback commercial real estate brokers that do a lot of buying and trading and selling with each other, and that's how we source most of our deals.
I see. And what percentage would you say is acquisition versus development?
Yeah, I mean, from these deals, we buy a lot of, really most of the value add is structural. And what I mean by that is it almost contractual. It's how you're negotiating the price of the real estate, how you're negotiating the terms of that lease, the amount of this that goes into the tenant. So really, compared to say, we'll call it a value add multifamily, on a value add multifamily, the day you take ownership is really when the work gets started. Right? Then you're trying to execute a business plan, trying to add value. On our deals, really a lot of that value add is more contractual, done before we ever take ownership. And then once we do take ownership, the nature of that triple net lease, they're kind of self-managed. The tenant, they pay their own expenses, they pay their own utilities, they pay their own taxes, their own insurance, they pay their own building maintenance. So, even if they need a new roof, they call and let us know, hey, roof's up, we're putting a new roof on, but they're footing the bill. So, from our side, in terms of management and development, it's more more minimal in this asset class compared to something like a ground up development or a multifamily there.
Can I pigtail onto that?
Yeah.
Quick? You had mentioned that the value add is more contractual. I imagine you mean that in the term of rent increases and lease increases over the term, or is there anything else that you do to increase that value over time?
Yeah, no, it's a great question, because a lot of people have a misconception that triple net means it's hands off, no value add, right? And in some elements that's true, right? You're not increasing occupancy because you start off, ideally with a fully occupied building. You're not having to work for those rent bumps because you've built in the lease, right? Every year, I know contractually the rents are going to go up, typically 2-3% a year. And because there's no expense line, my tenant's paying all their expenses, that rent equals NOI. And so I know with a high degree of certainty, I'm building value just through growing NOI, even if I keep my cap rate static. And then, the second way is through, really the contractual mechanism of a sale leaseback. And the easiest way to conceptualize that is putting a brand new 20-year lease. We will take yield from that lease for about 5 years, but we still have 15 years left when we go to sell it. And that's a long time. 15 years, you're still able to sell that at a relative premium to the next buyer. They may take yield from rents for 5 or 8 years, and they could sell it to a third buyer long before anyone ever has to worry about a renewal event. So, that's being on the front end of that, with 20 years left, that buys you a lot of time to, build value, take cash flow, take yield for your investors, and then still be able to sell at a premium. And so that's the second way. And then the third way, really the mechanism of a sale leaseback is often, coincident with that particular manufacturing firm being acquired by either a larger competitor or by a private equity backer. So, usually it's an opportunistic play where these guys will come in, having seen consistent, steady growth on that manufacturing firm. They buy out that firm, and now they're looking to effectively either reduce the cost of that acquisition, which they can do by selling off the real estate to pay off some of that acquisition debt, or they might sell that real estate to reinvest the money that was tied in that real estate into the operations. So if they're looking, hey, if we want to grow EBITDA faster, let's pull the money out of the real estate. We're not going to the moon, owning real estate. That's more steady Eddie, consistent returns. And, instead we'll add 2 more manufacturing lines and, 20 more headcount, and that's maybe a way that they can grow the business faster if that's what their goals are. So, but that, if they're successful, if that company grows and their credit increases in the form of stronger financials over the time we own it, then that can actually drive value as well. That ultimately adds value to your real estate when your tenant who's occupying it is stronger than when you bought it.
That makes a lot of sense. I have a few people who, when I'm explaining the sale leaseback process, when they're real estate investors, they don't get it. It's like, why would you not want to own the real estate? Yeah. But when you think of it from their perspective, it's exactly that, right?
Oh, yeah.
If I've got $4 or $5 million worth of real estate, and it's like, okay, I can put that $4 or $5 million in my pocket. Owning the real estate or paying that additional rent, whatever that is, $250,000, $300,000 a year, versus that $5 million. That $5 million might make them $1 million, $1.5 million in their operations. So they're looking at it saying
opportunity cost there.
Yeah. So
it's so important to know how other investors or investment groups make money, right?
Sure.
So, a private equity group, their investors, the way private equity groups make money on buying that manufacturing firm is by growing EBITDA. So they're able to grow EBITDA at a much faster clip if they're investing and trimming up the balance sheet and reallocating that money into their brand new baby there. So, when you put on that hat to go, okay, that's what's important to them. That's why they want to sell off the real estate, because the real estate isn't going to, grow at 3x returns that they're looking for, but that's okay, because we have a hard asset to back our investment. They do not. So they're willing to take on a little more risk.
Yep. That's awesome. That's awesome.
So the next question was, what's the ideal deal for you?
The ideal deal. I like it. I'd say, we love just ugly manufacturing, and what I love ugly real estate manufacturing. So, you one of those you drive by on the street and you look at, it's 4 walls and a roof, just forgettable, right? And maybe it's got a little rust on the corners, or, the landscape's not great. And that's okay, right? It doesn't need sex appeal. It doesn't need curb appeal. Really all it needs is to have a great tenant who's making something of value. And I want to be a part of that, be an investment partner by owning the real estate, being the landlord for the magic that's happening inside. So, when it comes to the perfect deal, usually I love manufacturing in the way that they're not making consumer goods, but they're making B2B type of products. So like parts manufacturers. And, we bought a deal last year that I loved. They made industrial mixers and dryers. And imagine like a KitchenAid on your countertop, but imagine the same thing that's 25 feet tall, right? These giant vats, the big spinners and custom blades and, huge fan blowers into it, and they make everything from cereal to like paint mixers for 3M. And I mean, just ugly stuff, but it's needed. It works. It kind of drives the gears of commerce in this country. And, those are the type of companies that, they're resilient to the highs and lows. They end up making a lot of money.
Yep. Awesome.
And your firm website mentions a focus on leaseback, and we've talked already a little bit about it, but why is it a focus of yours, a niche?
Yeah, I mean, comparatively, there's two ways to buy commercial real estate, and that's either buy a stabilized asset where you have a tenant in place, a lease in place, you're buying the real estate and you're basically inheriting that lease, right? That's one way. And on those, they're okay, but you end up going kind of back and forth on the price. And that's the main negotiating point. But a sale leaseback, it's more nuanced because, not only are you negotiating the price, but you're negotiating the lease. And to use an example, I can work with a seller, and I can go to my seller and go, hey, what's important to you? Are you looking to get the maximum amount for this building, or would you prefer to have a lower rent on the backside? And I can tell them, I can go, look, I can pay you more for this building, but in return, you're going to have to pay a higher price per square foot in rent. Or if you want low rent, then you can sell it to me for a relatively low amount, and there's always a range, of course, but, as long as it's supported by the market, you do have some wiggle room in there, and you can kind of find, really a more mutually agreeable solution for both you and your seller, because you're staying together, you're not walking away after the transaction. I'm becoming the landlord, they're becoming the tenant. So you're kind of, this is a long-term relationship, potentially 20 years. You better play nice and, find a way that works for both parties.
Interesting.
Very cool.
Can you tell us the story of your favorite deal to date?
I got a lot of favorite. That's like asking a parent what their favorite kid is, No, my favorite deal. One deal I really like was this deal that we bought in Mansfield, which is just south of Dallas. And it was kind of a stretch deal for us at the time. And we went through, and I led the capital raise on it. And the project, I won't use their name, but they were an aerospace manufacturer. And the first thing I liked about it, it's a little cheesy, but they made aerospace parts, one of them being for the C-130. So the plane I used to fly, they actually made the wing spars that, think of these big metal rings that effectively form the structure of the wing on the aircraft. And so that was kind of interesting. Yeah. And then, I got to tour the property, and I realized, in my head, I'm like, well, what if they leave? How incentivized? You always have this fear of your tenant leaving, right? And we had a long-term lease, and of course you have the contractual component, but you always ask, okay, contract aside, how likely are these guys to go, all right, what, we're done with this place, we're picking up, we're leaving, see you in court if you want it, right? And I went there, and I'm walking this property, and literally I realized that the production equipment in these buildings is actually like 3x the size of the doorways, right? And I asked them about it, and they're like, yeah, we laid the concrete, we brought the equipment, and then we built the building around it. And I'm like, this is a tenant that's going to stay here, right? I mean, they literally would have to like tear open the wall just to get the stuff out if they ever wanted. So that was really interesting, and just kind of seeing that element. And so we raised the money for it. They had just gotten bought by a private equity group. And about 2 years go by, and the CEO of the company comes to us and goes, look, we have a problem. I'm like, all right, what is it? And he's like, look, we've been growing. Our orders are through the roof. We can't fulfill enough here. But the good news was they actually had a lot of extra land. So we were able to work with them and negotiate an expansion. So we expanded their square footage by almost about 50%. And we were able to add all this. We have a GC component within our team. So we were able to directly oversee the construction and build this out. We were able to add all this extra square footage. So these guys were able to, effectively stay on location, stay happy, not have to, try to sublease it out and find somewhere new. And, we were able to make a lot of money for our investors. The tenant was happy. Really it was like risk-free development because we knew we had a fully occupied piece of property when it was done. We had pre-negotiated the price of the rent when it was complete. So really there was almost no downside, which is, almost unheard of in the investment game, but, as close to a risk-free value add as you could have at that point. And, it was great. And that was kind of really win-win-win across the board for all parties there. And, it was a nice kind of feather in our cap to go to our investors who were expecting, a decent stabilized cash flowing property and say, hey, we threw on a value add component here and, everyone wins. So,
yeah, that's awesome. Yeah, you got to love that when they built the building around their machinery.
Right?
Fantastic.
Where to go?
Yeah.
Yeah, right.
Yeah, it was funny to see.
That's great. So thinking about, how you operate and how you guys work, obviously you're raising funds, you're deploying those funds. Do you ever work on joint ventures with other firms or co-GP, or how does that work?
Yeah, there is a ton of different models, and we've decided to become a little more vertically integrated than most. So we have, we've brought, components, for example, when we started years ago, we would, kind of contract out the credit analysis piece, right? And so we'd use, some outside independent groups to analyze the credit of the tenants that were going to occupy our buildings. And then after a while, we kind of grew and brought that piece in house. And then, sometimes we'd have expansions, we'd contract that out and eventually brought that piece in house. So we really, I would say bolstered kind of what we have in terms of being a full service sponsor, as opposed to, a more leaner model where you contract and partner a little more. So to answer your question, we do almost everything fully in-house at this point, as opposed to, a few years ago, we did more, some JV work and, partnered on some capital or equity components there.
Sure. Cool. Awesome. So we mentioned that, before the show, we've got some listeners who are brand new, some who, have a ton of experience. So, it's a pretty sophisticated, size transaction that you're doing. There's a lot of moving parts there. But is a sale leaseback a viable option for a brand new investor or somebody that may be new to industrial or new to commercial in general?
Yeah. At the end of the day, if you're coming in, you're a passive investor in multifamily or one in industrial, you're passive, right? There's not a lot of hands-on things to do. And really, that I would say makes the other piece, your trust in the sponsor doubly important. So, in terms of, what deal to go into, personally, I think that's very secondary compared to the team that you're investing with, so, find a sponsor you like. Find, really the best way to do it, in my opinion, is, ask for referrals, recommendations from people that have invested with other groups. And, that's personally, I invest with some other groups as well. And, some of my favorite people are ones that have been referred to me by just buddies or, people I've met in investment groups, or like, hey, I've put some money with these guys. They do a great job. They deliver. And it's such a, I would say vote of confidence for, going in to look at that first deal, because you already know, you got, the piece of trust, at least for that sponsor piece. But yeah, when you're analyzing stuff, the two main pieces are cash flow and appreciation, right? Mm-hmm. So decide what's most important to you. And, maybe you want a mix of it, but, a lot of deals are either going to be cash flow focused. They're performing, they're looking to deliver day one, and they might have some moderate value add, or, you're going to have heavy value add with, probably less cash flow because you're naturally reinvesting in the project, trying to have that big boost on the end. And I think, understand what it is you need, especially for your phase in life. Typically younger people like more of a value add, willing to take on a little more risk. And then as you get older, maybe start working in more of that, really call it income investing or passive, where it truly offsets, part of your money to live. And that, I think our deals just structurally, they're more of a defensive play where they're fully occupied, they have rent bumps kicked in or built in. And so ultimately, they're cash flowing from day one. We do monthly distributions. So these are cash flow machines. Nice. I'd say, they cash flow a lot better than competing assets, or especially in the, more liquid markets.
Mm-hmm. Yeah.
We're not going to have as much of a pop on the back end as, maybe a well-run multifamily or development, but it's a trade-off, and that's, kind of the sweet spot niche that we've sought to fill here.
Yeah, no, that's awesome. That's awesome. So it's exactly as you said. You're building this stream of income. If cash flow, that steady cash flow, is more important than upside appreciation on the back end, then it sounds like a great model for anybody. And I know personally, I've helped folks do transactions for sale leasebacks that are on a smaller scale. So it doesn't just have to be, if you're a new listener or a new investor or a smaller investor out there, it doesn't just have to be 10, 20, 30, $40 million deals. These happen on a smaller scale as well. And it's a great mechanism across the board, as you said, to just mitigate that risk of I'm buying a building, it's not a vacant building, or it's not a building that I have to worry about. There's only a year and a half left on the lease. So no, that's phenomenal stuff. So we've got one or two more questions on our end, and then some of our listeners are asking a few questions. So what advice would you give to somebody who is just starting out as a commercial real estate investor?
Oh, that's a great question. Just surround yourself by other people who've been doing this longer. I love, real estate investment groups. That was how I started. I was still flying. Yeah. I was living in Japan. Hell, my first investment group I went to was actually an online thing I did while deployed in Iraq. So I'd fly combat missions one day, I'd get like the next day off. And I was like fascinated by it. I'm like, all right, like this is almost more exciting than, flying combat missions. Not really, but it was new and different. And, honestly, it was fascinating. And just, I started learning about all these different just avenues and ways to invest and areas to invest. I never had heard of, self-storage and student housing and elder care. These were things that never even crossed my mind as opportunities. And, the more I was kind of around it, and it helps to kind of normalize to know, hey, what feels like a good deal and what doesn't, right? And the only way you can figure that out is to look at a lot of deals or bounce it off people that have seen a lot of deals, right? And that's why I love these communities where, you come in and, people are happy to help. Look at a deal, bring it to the table and go, hey, what do you guys think of this? And, hear a few other more senior opinions, and, it can really kind of help find the gems in the weeds and, everything in between.
Yeah, no, that's awesome.
Yeah, that's what we try to do with our mastermind, when people bring deals and then others can pitch in and give insights and opinion.
Yep.
Yeah, it's a great way to do it.
So we have another question here. Most of us are bombarded with offers for syndication or hard money or traditional loans. How does your financing structure compare to those models? What kind of returns do your investors get, and where do you find those investors?
That's a good question. So I'll start on the first part, the financing structure. I'm thinking that's referring to a return structure. Is that kind of the intent of the question, do you believe?
Yeah, Jason? Yes.
Okay. Yeah. So, the way we set it up is, we have a preferred return that comes in, it's going to vary deal by deal, but usually, we're seeing 8 to 9% starting pref. They'll typically cash flow fully from day one. So we start, usually less than a month after we close, we're pushing out the first distribution, and those go out monthly. And the reason we're able to do that quickly and consistently is because of the lease structure. So that triple net, we don't have any expenses to deal with. We just rent comes in, we pay the bank, we pay our investors. So because we've eliminated all that, kind of expense operational risk, we have an extremely consistent cash flow. And then as those rent bumps kick in every year, we will actually notch up our preferred returns. So, they'll go up a little bit every year. And that is our way of basically passing on that additional cash flow to our investor group. And then, we'll hold 4 or 5 years. At the end, when we sell, we return that investment capital, and then everything left over is treated as net profits. We do an 80-20 split. Other groups will do, some variation on that, but effectively 80% of the profits generated on the project gets split pro rata amongst the investor group. And then 20% is effectively our promote for managing the property well. So, and then, really, especially for a new investor, I think it's super important to look for skin in the game from your sponsors. And there's 2 main ways to do that. The one is financial. So you want to see co-invest. You want their pain to be aligned with your pain, and their their wins to be aligned with your wins. So we co-invest about 15% of the equity on every deal. And then the other one, which I think is even a bigger element, is recourse loans. So find out if your sponsors are taking debt on the property. Find out if that's recourse debt. So if it is, and those sponsors are signing personal guarantees to the bank on the performance of those loans, that means that sponsors absolutely aligned motivationally to make sure that that investment goes as planned, and will, really bend over backwards to, find options or use every tool in his or her toolkit to make that deal successful if it ever hits some headwinds there.
Thank you. Very interesting.
And then I guess there was one last piece, overall returns. So the overall returns is going to be a combination of that cash flow, paid out monthly, and then also that profit split distribution at the end. So, for us historically, we've been able to deliver high teens on an average annualized basis. But, you're going to see, kind of a range, but usually within that category for other commercial real estate asset types as well.
Okay, thank you. And we've talked about, people starting out in investing. And so Troy is asking, what would be the best strategy to approach these type of sale leaseback deals on a small scale in a local market? Do you have any tips for that?
Yeah, so typically if you come in, the biggest issue, really, it's important to know with a sale leaseback, your biggest risk is credit, right? And it's going to be, you have to take off the hat that you wear when you look at a multifamily deal, where, a lot of multifamily, you're looking at demographics, you're looking at household incomes, drive-by, number of cars on the highway, curb appeal, all this stuff. For a industrial single tenant deal, really all that is very secondary to the credit of your tenant. So, I would say unless you're trained or have a background in analyzing corporate credit, I would say definitely be willing to find someone who analyzes credit and be willing to pay them to have that first pass on the true, kind of financial stability and financial health of that deal. Because that's where 80% of your risk lies. So if you can analyze that well and feel good about it, you've got a rock solid, sleep easy investment. But, if you gauge wrong on that, then, really, not to say your deal is going to fail, but you're going to have a lot more work if you have to start working to re-tenant up that deal. And then the other piece is going to be lease term. So, there's a lot of opportunity out there on short-term leases. Tenants love them, of course. It gives them options. They're not locked in for a long time. So, they would love to do 3, 5, 6 years, but you're going to have a hard time buying a property like that, holding it for 4 years and trying to sell it to the next buyer with a year or two left on the lease. Because really, that's a huge unknown, right? Is that tenant going to renew or not? So I would say, the more ways you can work with that seller to try to add lease term, that really is the bread and butter for making fee, lowering the aggregate risk on, a sale leaseback type of investment, and giving that potentially next buyer more security in their investment, that they'll have a performing tenant for longer without having to worry about releasing.
Yeah.
I have a side question. Has it ever happened to you where a tenant left?
Yeah, so we've been fortunate. I mean, we've done 45, 46 projects now. Since our inception, we've never lost a tenant. We've never had a tenant, miss even a rent payment. Never had a tenant default on a lease. I think our biggest misstep was, when COVID hit. I think we had about 25 projects under management. 24 of them just went off without a hitch, no issues, no problem. Paid rent on time. We distributed on time. The only hiccup was we had one deal that was a single tenant health club, and they were proactive. They were in Iowa, came to us and went, look, kind of in a bind, or forced shut. We don't know quite how long. And so they asked for a 90-day, basically pause on rent. And said, hey, we'll basically roll these 90 days in missed payments into the remaining term of the lease. We said, yeah, that's fine, given the circumstances. And we negotiated something similar with our lender. And luckily, after about half that time, about a month and a half, they were able to reopen, paid back the rent right away. And actually, our investors on the project ended up seeing a little higher than they would have otherwise. So, ended up being a good story. And, honestly, we were glad we had investment property in a business friendly state. I live in California. The gyms were closed here for like 15 months, totally different story out here. And so, it was nice owning real estate in Iowa where they were able to, flip it back on after no time at all.
Yeah. Very cool. Very cool. I have to apologize that my internet cut out there for a second. So you guys lost me for a second, but I'm back. If you've already answered this question, it was actually at the top, and we have two questions that I'm going to kind of partner them together and merge them together. And the first question is, it's this pretty specialized niche, and it was about how you get deal flow. And another question was, can you find deal flow like this on a smaller scale? So kind of a deal flow question. You mentioned brokers and working with brokers. What's that deal flow look like? How many are you getting annually? How many deals are they putting in front of you? And then to piggyback on that, how can smaller investors find deals, you think?
Yeah. So, really, it depends on the size of the project. There's going to be a threshold for when it makes sense for one of these guys to bring in a broker. But, you can ask around in most brokerage firms, ask them if they have anyone who specializes in sale leaseback, and they'll be able to tell you if they have anyone. Conversely, you can go direct. That's a little tougher, but it helps if you have, people in private equity or have people that, really kind of see under the hood or interact with, executive leadership. There's a lot of folks that have people ready to retire. That's a great catalyst for people about ready to be acquired. Just looking to, how do I extract some money out of this machine that I've built, and that, hey, guess what? You don't necessarily need to hemorrhage the whole business. You can just sell off the real estate. Sometimes they'll divide the real estate from the company. That's the way to, kind of pull those assets out, return some capital to the founder, the well-deserved capital at that. They built the business, they deserve a retirement, and then the company is able to, effectively continue to stay in operation now, renting that real estate, and it can be a win-win for the real estate investor there too.
Yeah, absolutely. Absolutely. So on a small scale, to just kind of piggyback off of that, I've dealt with a few. I'm meeting with one tomorrow, and they have a 14,000 square foot collision business, and they've been in business for 40 years there, and they've got 2 or 3 locations, and it's exactly what you said. The guy's close to retirement and says, I want to do a lease back of 5 to 10 years. I'm dealing with another client right now that we're about to go under contract, and it's a manufacturing facility, but small manufacturing facility. So there are deals out there on a smaller scale with this same strategy.
Yeah, no, 100% there. So, yeah. And even going in, I would encourage you to, spend the money on someone to help, run some credit analysis, looking under the hood, if that's not your core specialty. And the other piece too, that I find people kind of get hung up on is site level financials. And what I mean by that is if you're buying just one particular building, but your tenant has multiple locations, you should find out how important that building is to the overall operations. So, really work to get kind of site level financials in comparison to the company as a whole. And that way you can kind of back out and find out, is this a money making profit center or is this a money losing liability for the company? Because even if you have that contract, in the event that that company ever went into Chapter 11, but assuming Chapter 7 is full liquidation, right? Chapter 7 means we got no way out. We're selling this thing for parts. Chapter 11, though, means, hey, there's still a viable business here. We're simply restructuring. Part of that restructure, they're going to go, what part of my business is making money and what part is not? And if you own the real estate around a part that's making money, chances are your lease is going to stay intact and you won't miss a beat even collecting rent. On the flip side, if your real estate is around a money losing part of that business, they are going to walk away from that and the judge is going to allow them to. So that is a major piece that a lot of people don't think of when, looking at under the hood at the credit of a tenant there, to find out not only how strong is this overall corporate entity, but, the location. I want to see, how this stacks up compared to some of the other sites, for this tenant or company.
Golden nugget right there. That's awesome. That's great information. Aurelian, do we have any more in there? Any more from the group?
I think we've covered them all. I think we
have. So, yeah. So Neil, is there anything that we haven't covered that you think people need to know about this asset class or about your company in general?
So there's something weird I love about industrial, and it is one of the most depreciating assets out there. And I know that sounds super funny, but no, I mean, depreciation is great for any sort of equity real estate investment, as you and your listeners probably know. But I've found, especially over the years here, from a comparative basis, industrial tends to benefit from accelerated depreciation to a outsized level compared to some other types of real estate. So we usually, you do a cost seg accelerated depreciation study, and you can end up with significant tax losses, especially the first year. Sometimes 50-70% of your investment in the form of losses. And again, these are paper losses, tax losses that simply can be used to offset other forms of passive income. So, really a nice extra benefit from, folks who have excess capital or passive income coming in that they're looking to offset.
That's awesome. Yeah. So a question, kind of a nuts and bolts question, is that tax loss able to be passed to your LPs, or is that more
yes?
Okay, great.
Yeah. Awesome. I had a CPA give me this little nugget, and he's like, depreciation follows ownership. So if you're an equity investor, that means you're an owner in that company, and the depreciation will by default flow to you.
Fantastic. Awesome. Another golden nugget right there. So fantastic. This has been full of them today. So Neil, we really appreciate it. This has been a fantastic interview. I think everybody here and everybody that's going to watch this is going to learn a ton. So, going forward, is there, how can people get a hold of you? If they have a deal for you, if they're interested in your company, how do they get a hold of you?
Yeah. The easiest way, just drop me a line. My email, it's Neil, Neil at magcp for magcapitalpartners.com. Or just go to our website. We've got some good information kind of on the industrial space and the sale leaseback side. That's magcp.com.
Awesome, man. Awesome. Well, this has been great. I appreciate it. And yeah, I can't wait to get this out to everybody. And again, everybody's going to learn a ton. This was phenomenal. Thank you.
Awesome. Thanks for having me on, guys.
Thanks. Take care.